In this Nonprofit Basics episode, I explain the meaning of operating foundation status for a private foundation under the federal tax rules, and I also cover the tests for obtaining and retaining that classification. The term operating foundation technically refers to a private foundation which makes qualifying distributions directly for the active conduct of activities constituting its charitable, educational, or other similar exempt purposes, in an amount equal to substantially all of the lesser of the foundation's adjusted net income or minimum investment return. That's a lot of defined terms to unpack. But the short version of that is a private operating foundation spends money on its own active programs rather than making grants to others. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. Private operating foundations are 501c3 organizations that receive contributions from only a small number of donors and do not qualify as publicly supported charities. By virtue of the way they are operated, though, they get some important advantages of public charity status, the most significant being that contributions to private operating foundations are subject to the same favorable contribution deduction limitations as are gifts to public charities. Also, private operating foundations generally may receive qualifying distributions from private grant-making, that is, non-operating foundations. However, a public charity enjoys many advantages that are not available to private foundations, operating or otherwise. Public charities are not subject to 6 rules and attendant excise taxes, which apply to private operating and non-operating foundations. These 6 rules are the excise tax on investment income, the prohibition on acts of self-dealing, required minimum annual distributions, the prohibition on excess business holdings, the constraint on making jeopardy investments, and the limitations on certain grants and expenditures. After I go through the qualifications for operating foundation status, I'll circle back to these excise taxes and explain them in a little bit of detail. So now let's start out by talking about how an organization qualifies for classification as a private operating foundation. The organization has to meet 2 tests, one of which has 2 parts, and the other has 3 alternative methods for meeting it. An operating foundation must satisfy test number 1, that is the income test, and test number 2, the assets test. So diving a little deeper here, the income test has 2 parts that must be met, parts A and B. The organization must make qualifying distributions directly for the active conduct of the activities constituting the purpose or function for which it is organized and operated. That's Part A. And these distributions must be equal to substantially all of the lesser of its adjusted net income or its minimum investment return. That's Part B. So let's focus on Part A. Qualifying direct distributions generally include amounts paid to accomplish a charitable activity or to acquire assets that are used directly to carry out the charitable purposes of the organization. This requirement focuses on the activities of the organization itself, rather than the recipients of the funding supplied by the organization. Thus, for example, the operation of a museum or a historic site or a similar type of activity satisfies the active conduct test. Reasonable administrative expenses necessary to conduct this exempt function are also considered direct qualifying distributions. However, expenses to manage investments and grants to other organizations generally are not direct qualifying distributions. Special rules apply to scholarship programs. Part B of Test 1 requires that the organization's direct qualifying distributions must meet a certain amount. That amount is defined as substantially all, meaning 85% or more, of the net income or minimum investment return, whichever is less. Generally speaking, the minimum investment return is 5% of the value of the foundation's investment assets. Thus, the threshold for measuring direct qualifying distributions in many cases will be 4.25% of the amount of the foundation's investment assets. That is, assuming that the amount of investment assets is relatively stable over the prior year. Test 2 is the assets test. Test 2 has 3 alternative measures that the operating foundation can choose from, and it gets a little confusing because the terminology is similar. Anyway, Test 2's 3 alternative measures are known as the assets test, the endowment test, or the support test. The assets test under Test 2 requires that substantially more than half of the foundation's assets must be held for use in the foundation's exempt function activities. So for an organization, an operating foundation that has a museum building, for example, the museum building asset value would probably meet this assets test. The second alternative here is the endowment test, and that is met if qualifying distributions amount to at least 2/3 of the foundation's minimum investment return. That is, 3 1/3% or 3.33% of the endowment. The third alternative here is a support test that looks at where the foundation's support comes from. Under this test, at least 85% of the foundation's support must be from a combination of the general public and 5 or more exempt organizations, not more than 25% of the support from which may be from any one exempt organization, and not more than 50% of the support may be from gross investment income. So this latter test is rarely seen in my practice anyway. Most operating foundations focus on meeting either the assets test or the endowment test. But I digress. Because the definitions for the endowment test parallel the income test described above, an organization whose endowment income is less than the adjusted net income will always meet the endowment test if it meets the income test. So the next area worth talking about is how and when a private foundation can go about obtaining IRS classification as an operating foundation. A newly formed organization that wishes to obtain a determination that it qualifies as a private operating foundation at the same time as it applies for its determination of exempt status as an organization described in Section 501c3 can do so in one of 2 ways. First, if the organization has been in existence for 1 or more years, it can provide financial information with its Form 1023 showing that it meets the tests described above. When a new organization uses this approach to obtain classification as an operating foundation, it's required to use the aggregation method, which I'll get to in a few minutes, to satisfy the tests for its first year in order to be treated as a private operating foundation from the beginning of that year. It must continue to use that aggregation method for its second and third tax years to maintain its status for those years. As an alternative to this first method, which relies on actual financial information included with the IRS Form 1023, is to use an opinion of counsel in lieu of actual financials. This second method is an option if the new organization can attach to its IRS application either an affidavit or opinion of legal counsel or from a qualified accountant that sets forth facts concerning the operations and support of the new organization to demonstrate that the organization is likely to satisfy the requirements to be classified as a private operating foundation, or a statement describing the proposed operations as a private foundation. This might be a viable path if the new organization knows that it will receive a contribution of a valuable, say, museum building, and so it can expect to meet the assets test from the very beginning. New organizations that seek to obtain private operating foundation status as part of the exemption application process should expect that the IRS will take longer to review that application as compared to the review timeline without the operating foundation complexities. In some circumstances, it will be better for the new organization to obtain the IRS determination letter as a private foundation first, and then subsequently, after the actual financial performance satisfies tests 1 and 2, the new organization can go back and request reclassification as an operating foundation using IRS Form 8940. While this latter approach may take longer, the overall goals of the new organization may be easier to reach if it follows this path. Once the operating foundation is up and running, the foundation has to continue to meet these requirements. It may meet the income test and either the assets, endowment, or support test, by satisfying the test for any 3 years during a 4-year period consisting of the tax year in question and the 3 immediately preceding tax years. It may also meet the test based on the total of all related amounts of income or assets held, received, or distributed during that 4-year look-back period. This is the aggregation method I referred to in the context of the new organization's application for operating foundation status. A foundation may not use one method for satisfying the income test and another for satisfying one of the 3 alternative assets tests. This means that if a foundation meets the income test on the 3 out of 4 year basis for a particular tax year, it cannot use the 4-year aggregation method for meeting one of the 3 alternative assets tests for that same year. So you can see that there's a lot to think about in meeting the operating foundation status. So now I'm going to turn to a brief discussion of these 6 excise taxes that I referred to at the beginning of this episode, the 6 of them, and then go a little deeper into each of them. These 6 are 1, the tax on investment income, 2, the prohibitions on self-dealing, 3, the minimum charitable distribution requirement, 4, the tax on excess business holdings, 5, the tax on jeopardizing investments, and 6, the tax on certain prohibited expenditures. All of these rules apply to grant-making foundations as well. So here they are in that order. Excise tax number 1 that I mentioned, the tax on investment income. The Internal Revenue Code imposes an annual excise tax equal to 1.39% of a domestic private operating foundation's or private grant-making foundation. The same tax applies either way. Anyway, it's 1.39% of the net investment income, which includes interest, dividend, rent, royalty, and capital gain net income from the disposition of property. The second excise tax is the tax on self-dealing transactions. Private foundations are generally prohibited from entering into any direct or indirect act of self-dealing. Self-dealing transactions include a wide range of arrangements between the foundation and its disqualified persons, and I'll get to that definition in a second. Because these rules are extraordinarily complex, any time a foundation manager becomes aware of a transaction with a person or entity which could be a disqualified person, the foundation manager should consult with legal or tax counsel before proceeding. In most circumstances, the self-dealing rules don't accept fair or reasonable transactions from the penalties, no matter how favorable the transaction may have been for the foundation. So, the definition for disqualified persons. Generally speaking, disqualified persons include persons and entities that fall within 4 categories. Number 1, foundation managers, which is a category that includes trustees, directors, officers, and other persons with similar authority over the organization. Number 2, substantial contributors, whether individuals or entities, to the foundation. Number 3, family members of such substantial contributors or foundation managers. And number 4, entities controlled by the foundation managers, substantial contributors, and their family members. For these purposes, family members includes ancestors, children, grandchildren, and great-grandchildren of disqualified persons and their spouses. Note, it does not include siblings, and it does not include cousins or further removed family members, just ancestors and descendants. But note that complex constructive ownership and attribution rules also apply. So when in doubt, check a little more deeply and don't assume that you're out of the category of disqualified persons. So back to the self-dealing rule itself. Any direct or indirect transaction with a disqualified person may result in onerous self-dealing taxes on the foundation managers and the disqualified person. Specific transactions which are subject to the self-dealing taxes include the sale, exchange, or leasing of property, the lending of money or extension of credit, furnishing goods, services, or facilities, payment of compensation or payment or reimbursement of expenses of a disqualified person, and the catch-all, transfer to or use by or for the benefit of a disqualified person of the income or assets of a private foundation. Generally, the payment of compensation or reimbursement of expenses to a trustee, director, officer, or foundation manager is permitted as an exception to the self-dealing prohibition, but only if the compensation or reimbursement is necessary and reasonable. So that puts a high premium on documenting the reasonableness of compensation or reimbursement of individuals who are working for the foundation. So what's at stake here? Well, where a violation of the self-dealing rules is found, an initial tax of 10% of the amount involved multiplied by the number of years in the taxable period is levied on the self-dealer, and a penalty of 5% of the amount involved for each of the years involved in the taxable period is also imposed on the foundation manager. Furthermore, the self-dealer is required to correct the transaction to the extent possible so that the foundation is placed in a financial position no worse than that in which it would have been if the disqualified person had acted under the highest fiduciary standards. Generally, this means that the self-dealer must return the foundation to the financial position it was in prior to the impermissible transaction. Additional self-dealing penalties at a second level apply at a 200% rate on the self-dealer. These are imposed if the self-dealer or the foundation manager refuses to make the required correction. So you can see that a self-dealing transaction is rarely going to be in the best interests of anyone. Excise tax number 3, the minimum charitable distribution requirements. The minimum charitable distribution requirements are met by a private operating foundation by definition. This is because a private operating foundation makes qualifying distributions of substantially all of its adjusted net income or minimum investment return for the direct conduct of its charitable activities. A grant-making foundation, however, is required to pay out an amount roughly equal to 5% of the value of its net investment assets each year in the form of qualifying distributions. Those required distributions must be made not later than the first day of the second taxable year following the year for which computed. For example, in a very general terms, a private grant-making foundation with a tax year ending on December 31 and which has held investment assets of $1 million during that year must make qualifying distributions equal to $50,000, that is, 5% of $1 million, not later than December 31 of the following year. The penalty tax for a grant-making foundation that fails to distribute the required amount is a penalty of 30% of the undistributed income. Excise tax number 4, excess business holdings. In general, private operating foundations, as well as private grant-making foundations, are prohibited from controlling any business enterprise. In most circumstances, a private operating foundation is permitted to hold not more than 20% ownership in a business. These permitted holdings are reduced, however, by ownership interests of all disqualified persons. And these disqualified persons are those described above in the self-dealing rules. Same definition. The permitted holdings can be increased in certain circumstances. It increases to 35% control if effective control of the business enterprise can be shown to be in the hands of one or more persons who are not disqualified persons. Furthermore, if the private foundation, operating or grant-making, holds less than 2% of the ownership interests of a business enterprise, the holdings of all the disqualified persons are ignored. A little bit about the taxes that apply for excess business holdings. A private foundation which acquires ownership interests in a business enterprise is subject to an initial tax of 10% of the value of the excess holdings, and may also be subject to self-dealing taxes, so make a note of that. An additional 200% tax applies if the excess holdings are not disposed of in a timely manner. However, there are some exceptions to the excess business holdings excise taxes. The penalty tax does not apply to a foundation which receives the business holding as a gift or as a bequest, but only if it disposes of any excess business holdings, that is, excess over the 20% or 35% threshold, within 5 years from the date of the contribution. The disposition period can be extended an additional 5 years if those holdings prove difficult to market, despite diligent efforts, and the approval of the IRS still has to be obtained before the initial 5-year disposition period expires. Excise tax number 5, jeopardy investments. The Internal Revenue Code also prohibits any investment by a foundation which may jeopardize the carrying out of its exempt purpose. This is unlikely to come up in the context of an operating foundation, but it can come up in a general grant-making foundation. Generally speaking, an investment is considered to be in violation of this rule if it is determined that the directors or trustees fail to exercise ordinary business care and prudence under the facts and circumstances at the time of the investment. The regulations specifically say that the foundation managers may take into account the expected return, the risks of rising and falling price levels, the need for diversification within the investment portfolio, and other factors, such as the type of security, the industry, the maturity of the company, degree of risk, and potential for return. No category of investment is specifically prohibited under these rules. However, the Treasury regulations note that certain types of investments are closely scrutinized, and those include trading in margin, trading in securities on margin, trading in commodity futures, investments in working interests in oil and gas, puts, calls, and straddles, the purchases of warrants, and selling short. The Treasury regs don't mention crypto, but curious how that would fall out in these rules if a foundation were substantially invested in that kind of a currency. Anyway, there are several important exceptions to the jeopardizing investment rules. The tax on jeopardy investments doesn't apply to property contributed to the foundation as a gift, but only if the foundation does not furnish any consideration for the contribution. In addition, certain risky investments may be permitted if they qualify as program-related investments, where the primary purpose of the investment is to a charitable objective rather than to produce income. So what are the taxes on jeopardizing investments? Well, they'll sound similar to some of the other ones we talked about. An initial tax of 10% of the amount of the investment may be imposed on the foundation if there's a violation of these rules, and a 10% tax may also be imposed on the foundation manager. Additional penalties on the foundation and its manager apply if the investment is not removed from jeopardy in a timely fashion. A board can protect its foundation from the tax on jeopardizing investments by preparing an investment policy with the assistance of a professional investment counsel and by maintaining good records of the basis for its asset allocations and individual investment decisions. This is a tax that rarely comes up, but it's one to make note of if a foundation wants to make an investment of a substantial portion of its investment assets in what would otherwise be thought of as a risky investment. So take note of it. Excise tax number 6, and this is a big one that covers a lot of different activities by a private foundation. This is the limitation on certain grants and expenditures that are referred to as taxable expenditures. The Internal Revenue Code includes a list of specific restrictions on private foundation activities. Under these rules, a tax of 20% of the amount involved can be levied on the foundation for any of the following types of expenditures, and these include direct expenditures as well as grants made for these prohibited purposes. So the first of 5 areas to talk about in prohibited expenditures are lobbying expenditures, number 1. Any expenditure that is direct or by grant to another organization. Any expenditure to influence legislation or carry on propaganda. For these purposes, legislation means an action by an elected body or by the public in a referendum, ballot initiative, constitutional amendment, or similar procedure. Lobbying does not include technical assistance, nonpartisan analysis, study, or research, or certain communications that constitute self-defense of the organization. We have an entire podcast focused on lobbying expenditures by private foundations, and I'll link to that in the show notes. The second category of prohibited expenditures are those for electioneering and voter registration. Any expenditure to influence the outcome of any specific public election or to carry on directly or indirectly a voter registration drive is a prohibited expenditure. The third category are grants to individuals. Any grant to an individual for travel, study, or similar purposes is prohibited unless it's made pursuant to a procedure approved in advance by the Internal Revenue Service. Category number 4, grants to organizations other than public charities. Any grant to an organization that is not a public charity is a prohibited grant unless the grantor foundation commits to exercise expenditure responsibility. And those are very specific rules that I'll cover in another podcast. Expenditures for non-charitable purposes. This final category of prohibited expenditures include those made for any purpose other than a charitable purpose described in Internal Revenue Code Section 170C2B. That cross-reference to the Section 170 rules refers to religious, charitable, scientific, literary, or educational purposes, or to foster national or international amateur sport competitions, or for the prevention of cruelty to children or animals. So those are the categories that are allowed under 170, and the prohibition is any expenditure other than for those purposes. There are a number of exceptions to the foregoing limitations. For example, Voter registration drives are sometimes allowed under certain circumstances. Grants to individuals can be allowed if the procedure is approved in advance. Expenditure responsibility is an exception to grants to organizations other than public charities. So a grant objective which appears to be prohibited under these rules can be achieved through careful planning. Any private foundation which is contemplating making grants or direct expenditures which may implicate these taxable expenditure rules should consult legal counsel before proceeding. As with the other excise taxes, there's a second-tier tax that applies if taxable expenditures are not timely corrected. The rates are 100% of the amount for the foundation and 50% for the foundation manager. So as you can see from this laundry list of penalty taxes and rules for private foundation, while qualifying as an operating foundation does provide some benefits over classification as a grant-making, non-operating foundation, private operating foundation still carries a lot of baggage that doesn't apply to an organization classified as a public charity. The IRS finds out about all the circumstances that can give rise to these penalty taxes by specific detailed questions that must be answered on the foundation's annual tax filing. That is the IRS Form 990-PF. The excise taxes themselves are calculated and paid with the IRS Form 4720. See links to these instructions for these forms in the show notes. So that's all for this episode. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.